Can you please provide details on gap and crap, and specifically why your plan says to get out? Does this rule contribute to your expectancy? So let me put this ahead of time. Everything that we do in the plan was optimized for optimal expectancy. So the answer, without looking at anything, is yes. It absolutely helped increase our expectancy. I wouldn't have added it elsewise. There's no sense in adding it elsewise. But let's talk about what gap and crap looks like. Now, here's the thing, is that there are gaps and goes and gaps and craps. Right here, this is a gap and crap where it gapped up 11%, crap the very next day. It gapped up 10%, took 2 days, but then it crapped back down, and then it continued to go down. So gap and crap, and of course, this is linked down below. You can have this. There's no paywall, no nothing. You click it, you got it. The gap is defined as the difference between one candle's close price and the next candle's open price. So I want to look at a real-time example on Lunar, because this is a trade that I was in. It had a 5.38% gap, and then it crapped the very next day. It had a 5.38% gap, and it crapped the next day. For this plan, we're only concerned with gap up and crap back down. A gap and crap is at least a 2-day pattern. The gap candle must finalize. We must see the end of the gap candle to find out where the bottom of the wick is, because you don't know at 9:34 a.m. where the bottom of that candle is going to be. You have to wait until the end of the day to find that out. So that's why I say it's at least a 2-day pattern. And it only starts if there's a 5% or greater up move. So on Lunar, it had a 5.38% from the close to the next day's open, 5.38%. So that's where I put the gap line was at the bottom of that wick right there. Okay, put a line on the bottom of the up candle's wick. If the price closes below that point within 3 more candles, then close the trade. What happened? It literally closed the very next day under that point. So I closed my trade right there. Now, I don't know what's going to happen in the future, and I don't know if I'm going to get out the very top, and it doesn't matter. All that matters is following your plan, whatever that plan happens to be, okay? And if that doesn't happen within 3 candles, then you just go back to following your other exit signals. Now, gap and go is a close above the gap that doesn't turn around. And this is a gap on AT&T. This was only a 3.5% gap, but it illustrates the point where it can gap up, pull back a little bit, but it never closed under that line and then run like crazy. So what's important about this is you don't have to be afraid of gaps. Not at all. Gaps are not scary. In fact, gaps end up with less risk than you would elsewise. Because, for example, I'm in OKLO right now, which gapped up yesterday 7%. I put the gap line at the bottom of that candle. This morning, it's up another 4%, and I'm going to let it run until I have a reason to exit. Now, why do I say it's less risk than it would be otherwise? Listen, there are plenty of people who have no idea what they're talking about who will tell you that all gaps get filled. That's not true. Some gaps get filled, yeah, but not all of them, because like there's been plenty of times where you've seen a stock gap up and go and it never comes back. How many times have you seen that? Plenty of times, right? So this one gapped up, and right now it's going, and I'm going to let it go. And when I'm taking less risk, if it closes under this point right here, I'll get out, because my stops are down here, which is more risk. I would need to wait for the 1020 to cross, which is more risk. So when it stock gaps up, you actually can end up taking less risk than you would elsewise. Since we're talking about OKLO, Enoch says, if OKLO gaps up enough again, you also move the crap loss up every time. Well, if it gaps up 5%, the new gap and crap goes into place. So if it gapped up 5%, so let's see what it did. So from yesterday's close to today's open was, oh my gosh, another gap. Look at that. 6.24% gap up today. So yeah, when this gap finishes, I'll need to move this gap line up because we just established a new gap up. Look at that. Let's go, OKLO. Let's go. But of course, I can't do anything. In fact, let me mark that for later on. Enoch, thanks for pointing that out. Because absolutely, this would establish a new gap. Pretty cool. Well done. Why is the leverage factor limited to 20% in the position sizing dashboard? There is no limit. And now, granted, you do you, right? You do you. But what do I talk about with leverage factor? When I talk about leverage factor, let's go to Tesla real quick, okay? Leverage factor to me means how much can I buy my option for in relation to how much is the current price. So, for example, let's clear this up here. If I bought this option here, the 370 for 965, So 370 was 965. Or I bought the 350 for 28.95. 350 for 28.95, right? One of these is obviously more expensive than the other, but let's break them down. Let's break them down. So this is roughly the 71 delta, and this is roughly the 95 delta. Okay. Oh, I got that backwards. Hold on. Okay, so leverage factor to me means, hang on. Leverage factor to me, I'm trying to make this a little smaller because I want more to the side. There we go. Okay. If the price of the stock is currently at 377.50, okay, equals, if I had 100 shares at 965 divided by 100 shares at 377, that would give me a 2.5%. That would be 2.5%. That's actually, did I do that right? We'll roll with that for now. I may have to adjust that. This divided by this, 7% leverage factor. Oh, yeah. Okay. So it would be equivalent to spending 7%, so $28 to get a share of Tesla, which is trading at $377. And this would be equivalent to 2% of Tesla trading at $377. That's really cool, but that's not exactly right? Because now we got to look at 71 deltas versus 95 deltas. This is the idea that it was at 100 shares, which you are controlling 100 shares, but you really have this many shares because of your deltas. So then let's take this one step further, and we go this times this divided by 100 should give me what I'm looking for. So this, 7.39% or 29% versus 1.81%. I may have got that a little bit off, but leverage factor to me means how much does it cost on a per share basis to this stock? That's how I look at it, right? Now, of course, the deeper in the money you go, the more it's going to cost. And because the more that it's going to cost, the more it's going to take. But remember, you're grabbing and improving your intrinsic value while simultaneously reducing your extrinsic value. And your extrinsic value is the part that will decay over time. Do Greeks decay per day or per trading day? In other words, do they theta decay more over the weekend? That's a good question. To tell you the truth, I've heard both. I've heard that, and here's the thing. You're forgive me, but neither you nor I are smart enough to try and outsmart the market makers. I think at one point in time, people had figured out, oh, if I sell the option on Friday, I can take the theta decay and then buy it back on Monday, and then I'll have made free money. It doesn't work like that anymore, right? So my answer is, if you're trying to find little arbitrage situations, it's not going to happen.